Hello, hello. Who do we got in here? So, Nalda, how are you? Nia, my boomerang partner. Corey Matthews, what's going on? AP Lens. Give people some time here. Let me know if you guys can hear me too. Give it a few minutes, let people jump on. Ed Plata, what's up, brother? So I don't usually go on live, but I wanted to do this basically as a test run and just to start doing it a little bit more often. Um, I'm thinking once a day, just kind of like a recap, talk about what's going on in the mortgage market, real estate market, interest rates, news that we're seeing. For example, recently you guys might have seen that, um, these memes and these posts about this new rule where borrowers with really good credit or high down payments might be penalized for having good credit and high down payments. Or you might have seen something like the Biden rule set to increase payments for home buyers with good credit, things like that. So I want to do these lives just to interact with some people and then also obviously download it. I have my camera going for YouTube as well, and then upload it to my feed. So that'll kind of just stay there, and we can make it interactive. In case you guys have any questions, and also just to keep the information current and have an idea of what's going on in the industry or just what's going on in general. So, the big thing that I posted recently that you might have seen on my stories is the loan level price adjustments, um, which is, that rule where they're saying that clients with good credit and high down payments might be penalized, which is crazy, right? Because a lot of people are like, why am I going to be penalized for having good credit and a high down payment? So that's what we want to really discuss and go over. And then, just some other information here. Like I said, I plan on doing more of these lives during the week. Maybe this time during the week every day. I mean, as much as my schedule allows, 6 o'clock or so, and just jump on and give you guys an update on what's going on, and then also get the content from me that I can share to my page so you guys can check it out after that. So what's going on? So basically, to cut straight to the chase, there are changes for people with high credit and high down payments where the pricing and the rates that they get is going to be affected. So there's going to be improvements to people with lower down payments and lower credit scores, and there's going to be increases to fees for higher credit scores and higher down payments. So what does that mean? Basically, what the government is trying to do is they're probably looking to get more people into home ownership, right? We've seen affordability be affected and rates being increased over the last year, so crazy that it's really affected people's ability to afford a home. So what they're looking to do is probably level out the playing field as much as possible, and that's why these pricing adjustments are coming into play. So, the government wants to make sure that people the majority of people can get into homes, which is good for us in the real estate industry, good for the economy overall, because people that buy homes tend to be, locked into their community, a little bit more involved, and it helps the economy overall. They're contributing to the local stores, local retailers, things like that. So what's going on is, if you have a high down payment and a high credit score, you're going to be impacted. What's not going to be impacted, or what's going to be a little bit better, is the higher loan to value ratios, which is basically lower down payments, and the lower credit score. So they're making it a little bit easier for those people to get into conventional loans. So first things first, this is only for conventional financing. This doesn't affect FHA at all. FHA is its own thing. So FHA, VA, USDA, that's all separate. This is just conventional loans. And really the impact is for people that are putting 10 to 20% down and their credit score is 740 and above. Those are the people that are really going to be impacted. Even like 680 to 740, there's going to be some adjustments there. And usually when we lend, right, if your credit score is 680 or lower, that's typically FHA territory, right? If your file comes in and your credit score is under 680, we're going to look to FHA because it's going to give you the best terms, the lowest rates, and probably the best approval. Even though conventional credit scores are allowed to go down to 620 and you can still qualify. It just gets harder from 620 to 680 for conventional borrowers with that score, because the rates, the fees are typically a little bit higher because it's not as attractive to the lender. It's a lot more risk. So they're trying to level that out. So what I think is going to happen is that, we don't know. No one has a crystal ball. It is what it is. They're definitely, everything you're seeing is true. They are raising costs and fees for people from that 680 to 740 range. Now, it's not going to be something you see on a loan estimate. It's all back end costs. So it's stuff that we might see as a loan officer, the client wouldn't necessarily see. But what's going on is, again, they're trying to level the playing field. And I think some of those people that would have been FHA clients now might be conventional, right? Which is going to help them with their offers, maybe help you as agents to make stronger offers with people that have the lower credit scores and still qualify, right? So the government, again, what they're looking to do is combat the affordability issue with kind of leveling the playing field for these conventional and FHA buyers. Does it impact the higher end? Yes. Now, here's the thing. It's important to note again that these fees aren't fees that someone is going to see on their loan estimate, right? Or on their closing cost worksheet. They're just adjustments that are made on the back end when the loan scenario is priced out by the loan officer. So when I go into my pricing portal and I put in your scenario, I'm going to see different rates and costs for those rates. If you guys have heard of points before, if not, you can go check out my other videos. But the points and fees associated with different rates are what's being affected. And if you have that excellent credit, high down payment, you're going to be paying more, after May 1st than you would now. That's basically what's going to happen. Now, again, I think it's going to be beneficial. One, it's getting more people involved in the overall buying process. George, what's going on, brother? Good to see you. It's getting more people involved and aware, right? So now, because of all these social media posts and everything that we're seeing online, and everyone saying that, oh, if you have excellent credit and you put a high down payment, you're being penalized, right? It's bringing more awareness to the fact that you don't need 20% down. And sometimes, and we're going to see this with people that do have that 20% down payment, maybe it makes sense for them to only put 10% down to get a better rate or better terms, right? Maybe they don't need to put the whole 20% down. And also it's letting people know that there's conventional options with low down payments, which still we come across all the time. The loan officers in here, you guys know that people still think you need 20% down. The realtors in here, you guys know you need 20% down, and you don't. And they're making it a little bit more competitive and affordable if you don't have 20% down and you don't have excellent credit to still make things work for you. So I'm curious to see how this plays out, in the real world when we're actually doing these loans, because the thing is, most people with low credit have higher debts, right? That's why they have lower credit. And then on the other factor of this is qualifying is just not about your credit score and your down payment. It's about your debt to income ratio, right? It's a whole picture that we look at. So if you have low credit and higher debts, your DTI may be too high to qualify anyway, right, for a conventional loan. So it's always still going to make sense to keep your credit score higher and your debt low, especially if you want to qualify for a conventional loan. But if you have low credit with higher debts, yeah, there might be these adjustments that help you out with your pricing. But if your DTI is too high, you might still have to go the FHA route. So they're doing what they can to try to even the playing field. Is it going to affect people? Again, yes, it is, especially if you have really good credit and a really high down payment and you're buying a single family home. This is just for conventional financing, right? This is not for FHA, VA, USDA, any government products, just Fannie Mae, Freddie Mac, FHA financing. So, we'll see what happens. Again, I do think it's bringing attention just to home buying overall, that you don't need 20% down. You can get low down payments, and they're trying to make it more affordable for those people with low down payments and lower credit to get into home ownership. The other thing with this is that the mortgage industry is always going to find a workaround, right? So when things like this happen, mortgages still have to get done. Banks want to make money. They want to make options for people. So when we've seen rates go up so much over the last year, what have we seen? We've seen temporary buy downs, right? We've seen non-QM loans like bank statement loans and DSCR loans when you qualify just on the rental income from a property. So the mortgage industry is going to get creative. George, what are you saying here? Low credit score applicants might be too high with their DTI, but wouldn't that be the point? Doesn't it make them monthly cheaper for those lower credit? It does, yeah. So that's what they're trying to do. They're trying to make it a little bit cheaper on the front end, maybe with points, get a better rate, so that they can still fit into that conventional bucket. The other part of this is, and you realtors, this very well. If you get an FHA pre-approval, you tend to shy away from it. Now some of those buyers might come through with conventional pre-approvals. And again, if they qualify, they qualify. So their score and, their down payment, things like that, aren't going to impact them as much if they can get into conventional financing. So then when we're making offers, they can be more competitive, and some of those FHA people will work into the conventional bucket. At the same time, maybe FHA, because FHA has made some changes too with their MIP, the mortgage insurance premium, right, and what they decreased over the last couple months, taking it from 85 basis points down to 55 basis points. That's a huge cut to make FHA a little bit more affordable. So now conventional is coming in and saying, okay, we're going to make it more affordable too. And the other thing to keep in mind here is that I think I saw a statistic from our management team where this is really affecting the people, 740 plus, 700 plus credit with 20 to 25% down. That's about 30 to 40% of the population, right? Most people buy homes with low down payments, and most people have credit scores that are average, 680, 700, 660 to 720, somewhere in that range. So that's what we have to keep in mind about who this is actually going to affect, and then also what the government is trying to do. So we'll see how it goes. Again, the mortgage industry, the bankers, right, the people that want to make money are always going to find workarounds. They're always going to find things to say, okay, the government did this and we can't really change that. The government's going to do what they're going to do. They're making the rules. All these loans are being sold to Fannie Mae, Freddie Mac. So all we can do is play by the rules, right? And again, if someone's going to give you $300,000, $400,000, $500,000, they make the rules, right? They're lending you the money. You're coming in with a low down payment, even 20% down. It's up to them to say what they're willing to do and what they're not willing to do. And the government is trying to make things, again, more affordable. Yes, the headline is definitely clickbait. It's definitely been politicized already, right? So what we need to realize is that whatever body or political party made this decision, it is what it is. Now we have to work with it. So for you people that have excellent credit and have the down payment, maybe it makes sense to put a little bit more down, and maybe it makes sense to put a little bit less down. So the people that are really being affected, again, is if your credit is from 680 to 780, right? That kind of higher tier, and you're putting 15 to 25% down. Those are the people that it's going to affect, and not necessarily like you would even see it. The funny thing is, stuff like this happens all the time in the mortgage industry, and we get these letters and these announcements, and the buyers, the clients, you never really know, because this is all back end pricing. This is stuff you would never see, right? This is stuff that we see on our end as loan originators when we're pricing out loans, and we might notice subtle differences. But it's something you would never see. Now that the information is out there, it's definitely something you want to talk to your lender about and say, hey, I know, the government made these changes. Does it make sense for me to put less money down or more money down if I can afford it? Or does it make sense to maybe look at an FHA loan instead of conventional, or vice versa, right? This is not telling people to, let your credit or tank your credit so you get better terms. Because at the end of the day, if your credit is not good, you're still going to pay for it in the form of the type of loans you qualify for, right? Because if you can't qualify for a conventional, then you have to go with these other routes that are just more expensive because they're more risky. Even if your credit score is lower and they're making these adjustments, you still might fit into one of those more expensive boxes. So this is not, the headline is not, I might as well tank my credit because of what the government's doing. That's definitely not the route you want to go. And you definitely want to put down as much money as you can comfortably on a property, because it's going to affect your payment, and it's going to affect the balance on your loan. And obviously someone putting down 20% and someone putting down 3%, you have a lot more equity for the same. If everything's the same, you have a lot more skin in the game and a lower payment. So if you can do that, you want to do that. Again, this is just for conventional loans, not government loans. So no FHA, VA, USDA, and these changes that were made. What you can do if you want to see the chart, if you Google LLPA changes and look for a chart, it'll pop up. And LLPA is loan level price adjustments. And that basically means when the loan comes in again as a loan originator, when we plug the scenario into our system, it just spits out a bunch of options. And the changes, we can see them, the adjustments for things like your debt to income ratio, things like your down payment, things like your credit score, the property type. Is it an investment? Is it a primary, right? All those things go into what rates the system spits out at us. So those things are what's being adjusted. And if it comes, the scenario comes in with a 760 credit score and 25% down, it's going to be a little bit higher. Instead of, easy numbers of 6%, you might be at 6.125 now, right? 6.25 now. And then before, when you had a 640 credit score for conventional, you might have been at 6.5 or 7 with points, and now that's going to be a little bit less expensive for you. So it's just evening out the playing field a little bit. Again, to get more people into conventional loans. If you're looking for government loans, this doesn't really apply to you because these adjustments are just for Fannie Mae and Freddie Mac. So that's basically it for that. Again, I do want to do more of these lives. Maybe once a day, kind of in the afternoon like this, wrap everything up, talk about what's going on in the market, interest rates. I do my weekly post on rates every Friday, so I'll be doing that soon. Market is relatively unchanged besides this going on. This is just an adjustment, again, to the back end, not necessarily the rates, just the back end. So, we'll start doing more of these. And then, check out the recent podcast I did with DJ Dramos. Check out all my videos, things like that. And we can just keep in touch. I want to do more of these again to just get the content, download it, share it to my YouTube, share it to my page, and kind of make sure that we're all staying on track with the news. Rate Keeper. This is Ricky, right? For a buyer that has 650 credit score, but looking to buy high balance and qualifies for between them. Save them thousands in points. That's a good point too. So the other part of this is there's additional changes for different types of properties and different types of loans. So aside from just a single family purchase, conforming loan limit 400, 500,000, there's additional changes to things like high balance loans, ARMs, investment properties, second homes, right? Because in the past, some of these things weren't as dialed in with how they should be, right? So for example, take the insurance industry. If you are looking to get health insurance and you're a smoker, your insurance is a little bit higher because you're a little bit higher risk. If you're looking for car insurance and you have accidents or DUI on your record or something like that, points on your license, your premium is going to be higher. So what they're doing is pretty much the same, and they're looking at things a little bit more detailed, right? So before, again, it would be if your credit was over 740, 750, it was all the same. Now they're breaking it down a little bit more. If you were putting 20% down to 40% down, it was all the same. And now they're breaking it down a little bit more. At the same time, they're trying to make it more affordable for people with lower scores and lower down payments. So yes, if you are in a high balance loan and the PMI is high because of your credit score, now this can kind of help that to still help you qualify for conventional loans. Again, the idea is still to get your credit score as high as possible, save as much money as possible for down payment. This doesn't change that, because if you have a low credit score, you likely have a lot of debt, and that debt to income ratio is going to affect what you qualify for anyway. You might not be able to get into a conventional loan, and there's also going to be changes with this for debt to income ratios, right? Which wasn't really a thing before. So before, if you were looking for a conventional loan, you're putting 5% down and your debt to income ratio had to be under 45%, it could be 25%. You would get the same rate as a person with 44%. It just mattered that it was in that bucket. Now, there's going to be changes to the rates if you have lower debt to income ratios, higher debt to income ratios based on the risk. So it does make sense in some points. And again, the people that have the 740, 760 credit with 25% down, buying a single family conventional, property, primary residence, is probably 30 to 40% of the overall population who it's really going to affect. A lot of people might have excellent credit, but they're putting down 5-10%. A lot of people might have terrible credit, 650, but they're a business owner, self-employed, and they have the cash and they're putting down a high down payment. So it could help them because of the credit score. Now, the last thing is, this is not going to be something that causes a real estate crash, because I've seen that in the comments too. Where they're like, oh, here we go, 2008 all over again. This is not subprime lending, right? This is not making it easier for people with lower credit scores to qualify for loans they shouldn't have. They still have to qualify under conventional guidelines, right? They still have to qualify with the debt to income ratios, afford their payment. Not just like, okay, we're making it easier for everyone and we're going to give these subprime loans. That's not what this is. This is getting more people into conventional financing with a little bit of love on the rates and the cost. I think I saw a post that said, it's a $40 increase a month on a $400,000 loan for someone with excellent credit. And, it's going to add up over time, but there's ways, and again, we'll see what the mortgage industry does, where we'll have workarounds where it's like, okay, instead of putting 20% down, maybe put 19. You'll have PMI for 6 months. When your value comes in, we can do another appraisal, so show that the value went up and get rid of that PMI, things like that. Maybe put down 10 or 15% instead of 25 because you get a better rate. And then after closing, maybe you can recast, right? You can make the payment after closing, put an extra 10% down after you close just to get the loan amount down, things like that. And then the bank can recast your loan. Recasting is basically, you start with a loan of $400,000, you close, you put another $20,000 down, and then your loan is $380,000, so they recalculate your payment based on $380,000, things like this. So the mortgage industry, again, bankers, they're all here to make money. They want to make sure people are closing loans. It's been a rough 12 months if you've been in real estate or lending. So this is one of the fixes for that, right? They know that people with 740 credit, 760 credit, 700 credit, and 20 or 25% down, they're going to be okay. And they're going to win most of the bids. Who they're trying to help are the people that have low down payments and lower credit scores. And those people can get into conventional financing and compete in this market, right? And help us overall do more deals. And that's what the banks want. That's what we want. It doesn't mean that you should let your credit score go to shit. It doesn't mean that you stop paying your bills because you're going to get a better interest rate. I don't want my people to think like that. It's just a small adjustment to level the playing field to get more people into homes. So that's basically it. I said the same thing a couple different times. I see a bunch of people jumping on. If you didn't catch it on the live, I am going to share this. I'm going to upload it to my YouTube page as well. Share this on my page. I'll probably clip out some things and use them for reels. But again, more lives, more podcasts coming up. A little bit of everything, more content, because if we're not producing, we're consuming. And I want to consume a little bit, but I want to produce more, stay busy, give you guys more information. So that's where we're at on this. I'll probably do an update once we see what the mortgage industry does with these changes. If you see these posts, definitely send them to me. You can tag me in the comments of, it's going to be a lot of clickbait, a lot of politicized headlines around penalizing people with better credit and higher down payments. That's not necessarily what it is. It's not a penalty. It's just taking a little bit from, the benefits they were already getting, right? So if it was already more expensive and harder for people with lower credit scores and lower down payments to get into conventional financing, they still qualified, right? They still had 2 years of work history. They still had the necessary savings. They still met the minimums. It was just harder for them to get into conventional loans. Now they're evening it out for everyone, which is going to help the market. It's going to help it be a little bit more even, and it's going to shake some things up for sure. So we'll see. But once the mortgage industry comes back and makes some changes, which they definitely will, we will update you and keep you posted. Again, we're doing more lives, more podcasts, more content. So stay tuned. I'll talk to you all soon.